Now, Executive Suite with WPRI.com reporter Ted Nesi.
Welcome to Executive Suite. I'm Ted Nesi, and this week we have a really terrific guest who I'm excited was able to make the time to join us. One of the most influential economic officials in our region, even though you might not know his name too well, and that would be the President and CEO of the Federal Reserve Bank of Boston, Eric Rosengren. Eric, thank you for joining me.
Nice to be here.
Thanks for making the trip down from that tower in Boston you guys have up there that we see in the pictures. So when I said the president of the Boston Federal Reserve was coming on, people, I think, felt like the civics class question they weren't 100% sure about. They know the Fed is a big deal, and they know it matters, but people aren't always sure exactly how it works, why it's important, something with rates, something with banks. How would you explain to the average viewer watching today the importance of the Federal Reserve to the country?
Well, the Federal Reserve is the central bank. So what most people are aware of is that we set interest rates. So we meet at a meeting called the FOMC, and at that meeting we decide whether interest rates should stay the same, and these are short-term interest rates, or up or down. So that's what everybody knows Janet Yellen and the Federal Reserve for.
A Brown University grad, Janet Yellen,
exactly.
Chair of the Fed.
Yeah, she was just down here very recently, in fact. We also do bank supervision, so we're involved in a lot of the financial institutions around New England.
So you're poking around their books to make sure that things look okay and all that kind of thing?
Right. We're looking to make sure that the health of the banking system is still strong, and that were we to hit an economic downturn, that they would be able to weather the storm. The third thing that we do is we do a lot with the payment system. So a lot of, if you get cash, you'll see it's a Federal Reserve note, so that's tied to the Federal Reserve. And we've been very active in payment system types of issues as well. And then the final thing is that we're very active in our region, and the Working Cities competition is an example of that, where we try to work on projects that are relevant and important to the region that we're in.
And boy, when you guys come out with that FOMC, no meeting minutes are more exciting to people, or readouts. The national economic reporters go crazy when it comes out what you guys have decided on the interest rates. It's a big deal. You can see it on financial Twitter when that comes out. So the other thing people might not realize is that the Fed is then divided into 12 regions in the country, different ways. Nelson Aldrich, the Rhode Island senator, was part of the reason we have that system 100 years ago, if people want to read a history book. But the Boston Fed has just about all of New England, a little bit of Connecticut's with New York, but you have just about everybody. What's your role specific to Boston? You know, the interest rates are set nationally. You're not setting like a Providence interest rate or something. So what's the Boston's Fed's role for our region?
So we do set national interest rates, but we take in the regional diversity. And one of the advantages of having a central bank that has 12 different regions is that different things are occurring in different parts of the country. So we don't have a lot of oil wells here, but at the Dallas Fed, they have somebody who knows a lot about oil. We do a lot of finance in New England. We do a lot of high-tech type of work. We do a lot of pharmaceutical type of work. So if there are trends that are going on there, that would be something that I would bring to the attention of the committee. And we have different perspectives. So the idea is to make sure that there's a wide diversity of opinions that are expressed around the table. At the end, we always have to come up with a decision of interest rates, either up, down, or the same. But it's important to have as much input from all around the country to make those decisions.
So part of your job is kind of be the eyes and ears for this region when you go down to Washington, you all try to figure out where the economy stands right now.
That's exactly right.
So you're here today. You're in Rhode Island to hand out money, so you're probably pretty popular as you go around the state. $400,000 each going to Providence, Cranston, and Newport as part of this initiative that you've been doing out of the Boston Fed for a little while called the Working Cities Challenge. I actually referenced it a little while ago. What are they going to do with the money?
So these are projects that each city decides on by themselves what they think is the most important thing to be focused on. So different cities have different needs. Cities are in different areas of development. So I was down in Newport earlier this morning. They're talking about focusing on the north end of Newport, which hasn't prospered to the same extent as some other parts of Newport, making sure that some of the low and moderate income areas of that city are able to thrive in the same way that the rest of Newport has. And they have a project that's really focused on bringing together the entire community to make sure that actually does happen. In Cranston, where I just came right before this broadcast, we focused on the discussion of how the population's changing over time, how it's a more diverse population than it had been at one time, and how to make sure that there's one Cranston. Again, it's a little bit of a geographic difference, that making sure
east versus west.
East versus west instead of north versus south. as it was in Newport, but in both situations, different parts of the community are prospering to different degrees and making sure that the entire community benefits from the kinds of things that a community can provide. So the goal really is that they come up with one vision that includes the entire community, with a focus on low and moderate income individuals in their community. And we found that when we look around New England, the cities that have been successful at turning themselves around have been cities that really have been able to get the nonprofit sector to work with state government, to work with business leaders in a much more cohesive way than sometimes occurs. And that's a big differentiator between those cities that are able to be very successful and those cities that are not able to prosper to the same extent.
Bringing folks together. All right, we're going to take a break. When we come back, we're going to talk much more with Boston Federal Reserve President and CEO Eric Rosengren. Maybe get a little sneak peek at interest rates, so there's only so much he can tell us. Stick with us on Executive Suite. Welcome back to Executive Suite. I'm Ted Nesi, and very pleased to be joined this week by one of the most influential economic officials in our region, the President and CEO of the Federal Reserve Bank of Boston, Eric Rosengren. And Eric, we were talking before the break about this Working Cities Challenge. What brings you here today? $400,000 each in grants going to Cranston, Newport, and Providence for initiatives to bolster their communities in different ways. This initiative started a few years ago in Massachusetts. I think you're in the second round now of handing out some grants to different municipalities there. What was the original idea, the spark for this up at the Fed, and how's it gone so far in Massachusetts?
So the original idea, not surprisingly, started with research. There are a lot of economists at the Federal Reserve, so we started looking at data. And we asked, what is the difference between those cities that have really succeeded and those cities that haven't? And so we looked at major cities, both in New England, the mid-Atlantic states, kind of the northern Midwest, that have similar composition to New England. And what we found there was that cities that had found leadership throughout their community and rallied around one kind of collaborative idea have been much more successful than those cities that hadn't. So we tried to come up with a competition that kind of mimicked that. The idea of a competition is that we want the best ideas to win. We want to have a competition so that the types of cities that are really collaborating and have the ability to collaborate well together are the ones that are getting the money. And we're not providing the money ourselves at the Federal Reserve, so it's not actually money from our vault.
In fact, I think our sponsor, Rhode Island Foundation, helped with the Rhode Island money, I should disclose, right?
Yeah, so we got money from the state, and the state's been a very active partner in this competition. We've got money from national foundations, and we've got money from a number of private organizations around the state. So that's where the money's coming from, and we have a jury that's completely separate from the Fed as well. So our goal really is to make sure that each of these cities prosper as well as possible, and we're providing kind of the infrastructure for the competition.
And in Massachusetts, have you seen results in those first
So we
rounds?
have seen in our first competition was in Lawrence. Was the winning city that won the first prize at that time.
Sort of a classic place with mills that have kind of declined, trying to figure out the next step for them.
Exactly. It's a beautiful city that in 1960 roughly had the same median family income as the rest of the country. Since then, it's declined very significantly over the next 50 years. The mills closed down, a lot of the warehouses became empty and abandoned and vandalized. And so it was a situation where there'd been a long period of decline. But that city has come together in a very meaningful way, so they got the first prize in our first competition. I think they've been successful in a number of ways. One is they've really focused on integrating social services around the schools. It's a rather unusual model, but people pick up and drop off their kids through the schools. So they thought about how to holistically provide more social benefits to those people that are coming in, dropping off their children, and also thinking about what causes lack of success for the students, and it frequently represents problems in the family. So they tried to integrate, they came up with a method to try to focus on those type of issues. Not only has it been fairly successful within the schools, they've been very successful at getting other grants from other national foundations over time, as well as from the state. And so I think it's an example of a community that had a proposal, they built on that proposal, the same kind of partnerships that were used and the same kind of collaboration are now being used for other projects in Lawrence, and that's exactly what we want to see.
Sort of catalyze collaboration among different actors in the community.
Exactly right, and most of these communities say they're collaborating already, but frequently they're collaborating just on the edge. And this is really integrating the community in a more significant way. And one of the parts of this entire competition is they can only come up with one idea. So this isn't an RFP. We're not telling people what to do. And this isn't a situation where you can throw 5 ideas out and hope one of them gets funded. We want the cities to really do the hard work of figuring out what the most important thing is for that city to do. And then if they get enough collaboration and it's a really good idea, that's a project that we want to fund.
So our viewers in Cranston, Newport, and Providence, keep an eye on how it rolls out there. So I want to turn to, I can't have a Fed president on without talking about the economic outlook. You just gave a speech earlier this week referencing that some of the economic data for the first few months of 2017 was weaker than many people expected. I just yesterday was at the State House covering the state revenue for taxes was down to their surprise, sort of could be some of the same phenomenon. But how concerned are you as you look at that data coming in that the economy, do you think the economy is weaker than we hoped and the stock market might be signaling? What's sort of your view on where things stand?
So the first quarter, as you point out, was weaker than we expected. GDP, which is a measure of the goods and services produced in the economy, only grew less than 1%. So that's very slow. My expectation is, though, that was a lull and that we're actually going to see stronger growth over the second half of the year. Part of the reason why it was so weak was consumption was weak. People weren't buying lots of goods and services. But we think that actually consumers are going to come back and start spending again. In part, that's because more people are getting jobs. And partly it's because housing and stock market have been going up. That's a good sign for people to consume. And people's income seems to be improving as well. So those kind of factors are the kind of factors that we would expect in a more robust economy. So we are expecting growth to be a little bit faster than 2% over the second half of this year. That should be enough to continue to bring the unemployment rate down a little bit more. We already have actually a very low unemployment rate. Nationally, it's 4.4%. If you look historically at where the unemployment rate is, that's at the low end of where we tend to be. And so that's one reason why the Federal Reserve has started to raise rates.
One of the things you said that's interesting to me is, and I was thinking that I'm getting married this year. I thought GDP would up 3% by how much it costs to put on a wedding. But, you know, the economic recovery, this is now one of the longest economic recoveries since 1850. I was reading up today a bit. Pretty long in the tooth for an expansion. And it makes people worried that, does that mean a recession is kind of inevitable? You know, you get a certain number of years and you're going to fall into a downturn. What do you think about could this go on a lot longer than we're used to because it's been a little slower? Or do you think, you know, clock's ticking, we're almost there? What do you think?
Recoveries don't die of old age. They die of policy mistakes. And as long as we don't make policy mistakes, those can be policy mistakes that the Fed makes, that the federal government makes. It could be policy mistakes made abroad. Those are the kinds of things that start a recession. I don't see that as necessarily happening. So as long as we avoid those kind of mistakes that we sometimes have made in the past, there's no reason why the recovery wouldn't continue on for some time.
You mentioned a little over 2% growth is now what you're thinking we might be looking at for this year. You know, it wasn't so long ago that would have been seen as quite disappointing, and we've sort of gotten used to that as the new normal since the Great Recession. Do you think there's been a permanent downshift in how fast the economy will grow, or do you think we could get back? You know, you saw candidates saying 3%, 4%, 5% last year as they ran. Or do you think this is kind of what we need to get used to?
Well, it's partly what we need to get used to, in part because our population's not growing as fast as it was. So we were expecting a lot more growth at a time when the population was growing much more quickly. Also, our population's aging and more people are retiring. So when people are retiring, they're not working any longer. Mm-hmm. So that means goods and services don't grow quite as quickly as they otherwise would. And productivity has been surprisingly slow. So there have been periods where we've had much stronger productivity, but the last decade, it seems to have tailed off a bit. So all those would indicate that we actually only need to grow a little bit below 2% in order to continue to have labor markets tighten up. So our own estimate at the Boston Fed is that if the economy grows faster than 1.75%, that's enough to gradually bring the unemployment rate down. If we ended up growing slower than that, then the unemployment rate would go up. So 1.75 is kind of what you would want to do to just level off the economy over time.
Well, we will pray for no policy mistakes. We're going to take a break. When we come back, we're going to talk more with Boston Fed President and CEO Eric Rosengren about the outlook for your car loan or your auto loan or whatever else with interest rates. Stick with us on Executive Suite. Welcome back to Executive Suite. I'm Ted Nesi, and I'm talking today, very glad to have him, the President and CEO of the Federal Reserve Bank of Boston, very influential official in the economy, not only regionally but nationally, Eric Rosengren. And we've been talking about the economic outlook and where things stand with the recovery. I had one other question for you, a wonky question, I admit, Eric. So I was just looking at the employment data for Rhode Island, and in Rhode Island, we've seen the working age employment, 25 to 54-year-olds, is actually still a little below 78%. It was up in the 83% range in 2007 before this. And that was striking me because you'd expect those people would be the ones coming back into the workforce if we've had a recovery. Is that a trend you're seeing all over? Is it more isolated places like Rhode Island and some other states where just working age employment has not come back in the usual way in this recovery?
So if you look at labor force participation, the number of people that are actually working, that has been going down because of demographics. So some of that is just people aging out of the workforce. And in New England, we have an older population than the rest of the country. But in terms of the labor force that is working age, it's been a little bit surprising that that's been a little bit softer than what we might actually expect. One of the advantages of running an economy a little bit hotter, and I would call 4.4% nationally a little bit hotter than normal, is that it does bring these people back into the labor force. And so that's exactly what we're hoping to see, is some of those people that have had a difficult time getting back into the workforce after a long period of unemployment or other types of issues, able to take advantage of the strong economy right now.
People might remember at the end of the 90s, McDonald's paying bonuses and things like that for entry-level work because it's a hot labor force.
And you're actually seeing that in some parts of New England. So if you look at Maine, New Hampshire, and Vermont, they all have unemployment rates around 3%.
Yeah,
That's
low.
very, very low. And you just walk down the streets in some of those cities, and there are help wanted signs everywhere you look. And so that's an indication maybe the economy in those regions are a little bit too hot.
And so you mentioned running the economy hot, and it must be tough to balance what Vermont needs versus what Texas needs. And as you sit there in those meetings with the rest of the Fed leaders, your number one lever, of course, is interest rates. So you guys have done some other interesting stuff, which we're not going to get into in this show today. So right now, interest rates are still pretty low by historical standards. Anyone who's gone out for a car loan or a mortgage knows the rates are still, my father talks about his 18% first home loan back in the early 1980s in the Volcker years. How quickly do you think you and the other Fed leaders are looking at raising those rates to, I don't know if it'll come back to what we used to think of as a normal level, but to a higher level as you look out, speaking for yourself, since the others would have to agree?
So far we've raised rates very, very gradually. So we have a low unemployment rate, but we've only raised interest rates 3 times. And they were at historic lows because of the severity of the Great Recession. So we raised by a quarter of a percentage point, 25 basis points, 3 times. December 2016, December 2015, and then March of 2017. By historical standards, that's much slower than what we normally do. And that's in part been that inflation's been a little bit low and the unemployment rate was quite elevated. As the economy starts getting tighter, you might expect that over time, we're hoping to continue to do it gradually, but that depends on how strong the economy is over time. But my expectation is that we will get to more normalized interest rates. What would that be? For short-term interest rates, that would be more like 3%. Right now, we're a little under 1%.
Interesting. Okay. One of your economists, you mentioned the economists who do the work for you up at the Boston Fed, is Mary Burke. And she's done some really insightful work about Rhode Island in recent years, published some interesting papers. One of them, she tried to tease out, it's something we've wondered ourselves down in Rhode Island, why the state was hit so hard by the Great Recession compared to most other states, very much including Massachusetts or Connecticut. She found Rhode Island was hurt by the types of manufacturers based here, the things that they were making were particularly hard hit, as well as the state's larger housing bubble in home prices. She thought that had an impact. Have you looked at that research at all, and do those strike you as compelling reasons for why the state was hit so hard? It's now almost 10 years ago, but why it was hit so hard?
Mary's done some very nice work focused on Rhode Island, and I agree with her basic analysis. You went through more of a housing boom than the rest of New England during the good times prior to the Great Recession. As a result, when the Great Recession hit, you were less well positioned for that happening. And as a result, a lot of the construction trades that had accounted for a lot of the employment went down fairly quickly, which had a disproportionate effect on Rhode Island. In addition, you had a lot of manufacturing that was affected to a greater degree, had more competition from China as part of what our results are. All of New England tends to export to Europe as well. And the European economy hasn't done so well over the last 10 years either. So I think it's a combination of factors that account for why Rhode Island has been hit more severely. But I think Mary's work is very good in this area. So
you're going around, as you talk about the grant money, you're going to see Mayor Lorza, you saw Mayor Fung, you'll see Governor Raimondo. I'm sure they'll all be asking you, what's the secret, what's the wisdom? What should we be doing down here to get things sped up? When elected leaders ask you, as arguably the top economists in our region, what should we be focusing on? What do you tell them? What do you think is really important to get healthy growth in a state-level economy?
I'd really emphasize workforce development. I think we're in an economy right now that if the economy keeps growing around where it's been growing, we're going to have a shortage of labor in all parts of New England. So the unemployment rate was quite high in Rhode Island for a long time, but it's come down pretty dramatically more recently. And I think Rhode Island, like Massachusetts and northern New England, is going to be facing labor shortages as time goes on. So making sure that some of those people that we were talking about earlier that are outside the workforce get the kinds of job market skills so they can come back in and find fruitful types of jobs that give them the kind of benefits that give them a high quality of life. I think that's really what the focus should be.
And do you worry at all about the economic dynamism of our entire region in New England? Because as the place gets older, Rhode Island sees it just in, for example, the Medicaid rules as we have the most people over 85 as a percentage in the country. Do you think that demographic shift in the age of the population will stream down and affect the way the economy hums?
So the demographics is an important trend that we have to think about in New England because it has less inflow, tends to have a very different demographic composition than, say, some of the parts of the southern United States. So it is a challenge. One of the places that it comes up is challenges for state budgets. A lot of the Medicare, Medicaid types of funding affect state budgets in very meaningful ways. So to the extent that we have a disproportionate number of people that are retiring and are elderly and have more health issues, that is a challenge for public policy makers in New England. But I would say there's a lot of real positive things that are going on in New England. Brown's a wonderful university here in Providence. There are a lot of great universities all through New England. We have a lot of dynamism. We always have. The New Englanders tend to be very innovative, and I don't expect that to change anytime soon.
All the way back to Slater Mill, right? Mm-hmm. So would you say you feel generally optimistic right now about the outlook for the economy in the long term?
Yes, I'm very optimistic about the U.S. economy overall.
Good, because I'd be really worried if you told me you weren't. All right, thank you so much. We're all done for this episode. I want to thank you again, Boston Fed President and CEO Eric Rosengren. If you missed any of this episode or any other episode of Executive Suite, you can catch all of those on our website, WPRI.com. And of course, you can subscribe to the show as a podcast on iTunes. So we will see you back here next week on Executive Suite. Great.